Hey, welcome back to the channel that I'll financially follow, but hopefully not in this particular segment of the casino update. In this segment, I'm basically doing a year-long investment challenge, really highlighting, the dangers of these covered called ETFs that are really kind of running rampant on YouTube, Reddit, TikTok, and whatnot, because they really show these high yields and high income, and then the dangers of using margin with it. So I'll be going through a couple of these different. You got round hill, Rex, curve, yield boost, yield max, and then we'll talk about the underlying and what particular margin maintenance requirements does, and what is Robinhood doing about it too. Not just Robinhood, but also different custodians. So without further ado, let's get into it. So I've been tracking round hill over here. One, I use 2025 data to project it to 2026, and past performance does not dictate future results. I went with equal weighting. There's only two I definitely didn't want to go into because 2025 was just so awful with them. But what would happen with WPay over here, it also has similar equal weighting, and I'll kind of talk a little bit more what's happening with that fund change later on. But you can see that overall, what WPay did with the equal weighting and all their funds, and I did equal weighting with just partial, it's experiencing that same kind of net loss, even though the total return, I guess total return probably not the right verbiage to use here, but just saying, the total dividends received in relationship to the investment were just below 5% for the year. And ultimately, what does that mean in the grand spectrum? Because unrealized is unrealized until you actually sell it. And there's also going to be some kind of tax drag that happens on this too. Because ultimately, if it's not happening in a tax deferred account, you're going to be experiencing these dividends on your tax return, and what you're going to be experiencing this inside your portfolio. Looking over at the amortization table, just kind of tracking, what's going in dividends. I've made a commitment to this investment strategy. I'll always put in $2,000, and then, seeing what's happening with the interest. And with this year, we're looking at just only 2 months in. But if we were to extrapolate and say, hey, if I was going to get, $2,600 on this for the rest of the year, where would that put us? Then we're still kind of expecting like that break even based on this to be right here towards the end of the year. And granted, we'll see what ends up happening with the interest. But ultimately, it'll take about all year to go through this. Not really ideal, especially, since we don't like to spend more time than we have to doing this, but made the commitment, we're doing the strategy. So once a month, we're going to go in here and just kind of track what's going on. Going into our first one that I didn't want to invest in particularly, but I thought it was interesting enough to kind of still keep on tracking. That's YBTC. We can see that throughout the year, what's happening with its NAV. It's at $29 here in the beginning. It's at 21 over here. So it's lost a third of it already. And then with the dividends, this one's kind of always an outlier because it's the end of the year. Basically think of it as a bonus, whatever net profits it still had, it kind of paid that out. But ultimately, it will fluctuate up and down between the teens and the 20s. And with NWV, that's going to be the NVIDIA one. Not too bad on what's happening with the ticker price over here. Up, down, relatively stable. And then seeing what's happening here with the dividends. It fluctuates, but it's not anything too awful. It's okay. I don't hate it. Tesla, TSLW, we're looking at its NAV. It has a $5 differential between where it was at 32 and then at $27 down over here. We'll see what ends up happening, but we've also seen this dividend play out. At 32, it issued a 16 cents one, but here at 29, we had a 33. And just because it could be at a higher NAV doesn't mean that it's going to pay out a higher dividend, though higher NAV does correlate generally with higher distributions from these things. But it's always really important to note with these covered called ETFs that, higher distributions does really have a direct correlation to, the NAV erosion that we're experiencing. But a lot of it also has to do with the underlying. With these leverage products as well, it's like a quarter upside for twice the downfall. Going over to the coin one. This is going to go off Coinbase as underlying. We can see that it has a NAV of 22 and it went all the way down to 12. Womp womp. And then in doing so, as I mentioned earlier, that NAV sometimes correlates to how this dividend is going to go pay out, because it's not going to pay at 22 out of 12 unless it really, really performed well. But ultimately, we can see that this too also kind of went down all the way down to, 7 cents over here in the previous week. PLTW, that's going to be off of Palantir. We can see this thing, 37 all the way down to 23. And then it's been wildly varying, 16 cents, 48, 30, 30, 11, 18, 23. And that also is going to be based on what happens with their performance. Granted, it getting a haircut from 37 to 23 definitely certainly doesn't help. But you can see that, hey, this had a 23 cents not too long ago. It was at 11. Right over here, we're at 33. Maggie, this is off the Magnificent 7. Also, a crowd favorite. Its haircut hasn't been all too bad, and the dividends off of it has been relatively consistent. So, like the video over here, I don't hate it. I kind of like it in the grand spectrum of what this portfolio is doing. Then we have the HOOD underlying, HOOW. We can see that its NAV over here at $51 is 50% drop. Ouch, not fun. And then 50 cents all the way to 25 cents. It still has a fair amount of way to go before it goes into a reverse stick. But if it goes into that reverse split, who knows when that would be? Maybe it might be mid-year if it keeps up this kind of rate of decay. MSTW, this is off of MicroStrategy. We can see that its beginning year is 10 and it's almost, down to 5. It's getting there quick. So this one might be due for a reverse split probably by mid-year at this rate. We'll see what happens. I'll talk more about what's going on with the crypto market later. But we can see that, those dividends, direct correlation with this. It's gone down, it's going down with it. And then WPay. This one is their funds of funds. They were just having all their just round hill ETFs into here. And I really do like the fund of funds just for the fact that it gives you kind of diversification. So if you were just into here, then you're just feeling the underlying, where this might give you a couple different market sectors to kind of get into. Granted, most of it's always going to be talk, but most of it's going to be tech, but at least it's different company tech, and it's not just a singular tech company. They're going through a change where they're going to change the ticker as well as their investment strategy, deviating from their quote-unquote fund of funds into something that would be hopefully more stable. And their idea is to try to, stabilize the NAV and get consistent distributions. And that's something you're going to see as a common thread as we go through these other portfolios. So given that, I'm going to kind of, divvy up into this other part where we're talking about what's going on with the underlying. You'll see that just looking at year-to-date numbers, and I just want to talk year-to-date because this investment strategy challenge that I'm doing started at the beginning of the year and it's going to run all year long. We can see that the underlying has just suffered, and because of that, we see that direct correlation. Strategy, just as much. All of these are kind of just in the red for their year to date. So is the strategy, which round hill, Rex, curve, yield boost, yield max, really all that bad? Or is it really just like the underlying is a pick? When going into this particular market, you need to understand you need to pick volatile stocks. It's the volatility that will drive the cover called premiums. The more premiums they get, the more income they can pump out. They need that kind of volatility. If you're going off the S&P 500, in which they are covered call ETFs that do that, and I think that Neos is doing probably a really good job at it. And next year, I'll probably go into something like that and doing a year-long strategy, kind of, showing what lower yield can do and how that might be more stable compared to these high yield traps that people get caught in. So going off these volatile stocks, you can also see here, HOOD just taking a beating. Bitcoin, we all know its volatility, and it's going through its own crypto bear market right now. This is on the 1 day. Let's go look at the year. And will it recover from its 2025 highs? Who knows when it's going to. I think it will. It's just a matter of when. When we look at it trending over, this last decade, some recovery periods might be a year. Others have looked at years, going from peak to peak. And then going from peak to trough could even take a year at a time as well. So who knows what's going to happen with, its recovery. But you can safely say that coin, strategy, and HOOD have closely tied their market's valuations over to their own individual underlying, Bitcoin. A lot of people associate HOOD with the crypto markets because it allows them to get into it. Strategy is the largest Bitcoin treasury company out there, and then Coinbase is literally a custodian for cryptocurrencies. So when we go through a crypto bear market, we can expect that these three are going to be feeling it the most. Other tech companies in here, so NVIDIA overall, a lot of people will agree that, hey, this has been a real solid company. It's still kind of down from where it is in the beginning of the year, but not too bad. it's still down. Then going over into Palantir, Palantir, strong tech company, and it's got a lot of fingers in defense stocks and what's going on with this weekend. This might be an interesting stock to go watch on Monday, as well as, Lockheed Martin, Raytheon, and the rest of those defense stock industries. But I digress. We can see that, where it started in the beginning of the year is not where it's right now. And we've seen that with the other, cover called ETFs. It's the underlying is not doing as well, so it's going to go down. And because of these leverage products, it goes down twice as fast. And then our last one we're going to talk about is Tesla. Common thread, all of these underlyings, as volatile as they are, they're also in the red. So even though Roundhill over here has a lower yield than, Yield Max and Yield Boost, but it's still higher and it's leveraged, it's taking a bigger beating than what the underlying is. Even though all the underlyings are red, they're not nearly as red as these particular funds are. And when I started this strategy, I left $10,000 as a buffer in the market. I didn't want to use all the margin. I just wanted to go ahead, and that way, if the underlying goes really down south, you don't get margin calls. The margin maintenance requirements, they can fluctuate depending on the underlying. Robinhood can easily just decide and change it overnight, saying, hey, you know what, your margin maintenance requirement on this is going from 50 to 100, or, vice versa. Like, hey, we're going to go from 50% down to 25. But you always don't want to use 100% out, or you might get margin call. A margin call means they're going to say, hey, we're going to liquidate your position to satisfy the margin, or you got to inject more capital into your accounts. Part of this investment challenge that we're doing is, one, we're putting in $2,000 a month into it, and then the other part is the dividends are paying itself. So it's already put in, $5,100 worth of dividends. So it's already put in more than what I have. In doing so, we started off at 9, but it's saying, hey, your buying power in here, you can put more on margin. Even though your underlying is tanking, it is allowing me to get another gun to shoot myself in the foot with. And if you'll see it over here, it says my margin status risk is low. It says, hey, you could put more into here. It's almost like it's inviting you to do it. And I think that's the problem with Robinhood, especially with young adults. It gamifies the investments. It's good that people are investing, but also when you do trades, it has that little emoticon with the, congratulations. It could be a losing trade, but it's still going to make you feel like this is good. It releases the dopamine. It's a trap. And that's what I really wanted to highlight with this investment challenge, is show the dangers of what these things can do. And, ultimately I came over to Robinhood from Charles Schwab because the maintenance rates were half the costs, as well as the maintenance requirements on it were a lot easier. And I think that Charles Schwab does a great job, probably, one, making the rates high, that way you're less inclined to go do some crazy stuff, as well as two, making a higher margin maintenance requirement also kind of keeps you more into check. That way you don't get too far out of bounds, but going too far into margin maintenance. Now, I talked a lot about, Roundhill, and there's a couple different things I've been kind of monitoring as well. I did on my 2025 investment strategy challenge for the year was Yield Max. So I went ahead, this is what happened up here in 2025 when I did my exit all the way here at the end, locked it in, and, projecting out for 2026 based on 2025 values, and then what actually is happening in 2026, compare and contrast. And ultimately, you'll notice I exited, and between income received and what now is, realized because I exited my position, I had just less than 1%, loss. But then you factor in the margin, then it became, 2%. And then you factor in the tax drag, it probably comes out to 10%. But that's neither here or there. But what's important is looking at if I was to stay in that position and what would it turn out to be. Granted, this is projecting 2026, so this is just saying the whole year data, and this is what's currently happening down here. It's staying in that same kind of threshold of that, just less than negative 1%. And then, total dividends received, we were at $68,000 for last year, and then just adding on about $5,000 more. Overall, the dividends received just shy of 60%. So that's $73,000 in dividends received, and the current market value is right over here. And then you can see, granted, we know this is quote unquote realized, but for all intents and purposes, every dollar that's out is every dollar that's out of that NAV. So tit for tat. The only good thing about this point right here, there's no more margin. We don't have that additional drag on the portfolio. You could take these extra dividends and then, one, you could drip it. That stands for it's going to come out, you get paid the dividend, it goes right back into that same fund. Or you can do DCA, that stands for dollar cost averaging. Or you can go take it into another fund. So you can go say, hey, I did it, I have it, they all paid off, and then I'm going to put it into S&P. And then ultimately this number is going to eventually tick up, and it's already up 4% from where we started at the end of the year to where we are currently in this year. But we can just simply say that it's going down tit for tat. And that's kind of what's going on with Yield Max. Another fun one, as we talked about the dangers of higher distribution rates with high yield traps, was Yield Boost. They really kind of did their marketing on this one as dividends that are at 100+%. And ultimately, I did a simulation that when it started in 2025 and then 2026 based on the 2025 data. And then when we look at what's happening in these individual funds, this is what happened in actual 2025. This is what's happening in 2026. And this is what's kind of projected. And you can see that this is ultimately going down. The NAV is going down. Dividends going down, NAV is going down, NAV is going down, dividends are going down, NAV is going down. Actually, relatively consistent over here. This is actually NAV decay is not too bad. But the underlying we already talked about with Roundhill in the video. We liked it. It's not doing too shabby. MIDI, that's that Strutt Michael Saylor one. NAV is going down, dividends are going down. HUD, NAV is going down, dividends are going down. Coin, NAV is going down, dividends going down. We're seeing that corresponding trend, and I told you it was going to be a common theme in this. Is it one, what's going on with the underlying? Two, what's their overall strategy when it comes to these investments? And then three, you have to consider the distributions. The larger the distributions with these high yield traps, the more that it's going to have a direct correlation on the NAV decay over here. This one's directly climbed to the crypto markets too, so it's no surprise that we've seen, the haircut on the NAV as well as the distributions go down. And then Amy over here is on the underlying AMD. It's a tech company, deals with stocks, chips, closely tied with Supermicrocomputer and NVIDIA, but the NAV has gone down a little bit, and so is the dividend. I don't necessarily hate this one. I like it just as much as I like NVIDIA. Then some other ones I'm kind of tracking, we'll look at Rex. And I think these ones, they really try to do a job of marketing income and growth. So keeping that in mind, we'll see how much they've really tracked the income and growth. It's going to be what's going on underlying, but they try to say, hey, we're going to have lower rates to try to stabilize the NAV, and that way the NAV will go up. But hasn't. Granted, the underlying on COII is Coin, and Coin has been a dumpster fire. They're not really capturing that growth side. We got some income. We started at 6, we're still at 6, but not too great from where it started. Not a whole lot of growth when they say income and growth. MSII, the underlying on this one is going to be strategy. And we can see that, once again, not doing a great job of capturing any kind of growth, but the underlying has not been great. And VII, this is off of NVIDIA. This one's doing okay, but common thread between them all is that we kind of like where the underlying's been doing. We've seen that it has some kind of decay, but it's not too bad. But when you see where it's been over here, at the beginning of where it first started, it started at 26, and it's basically at 27 now. It's fluttered, it's fluctuated, it's gone up, it's gone down, it's tried to capture some kind of growth to it, but it really hasn't done it. But at least the income is still kind of pumping out. TSII, that's going to be the underlying for Tesla. We can see that, it started at 23, it's at 21. It's not doing a bad job of trying to keep it relatively stable while pumping out the income. And ultimately, this is going to depend on what's going on with the underlying. We see like 38 cents, but, in some areas over here, it was pumping out 8 cents dividends. So quite the fluctuation, but in doing so, hopefully that meant that they were keeping it more stable. They had 8 cents over here at 24, and then it jumps back up to 28 to 29. So doing something a little bit right over there, but also underlying. Key word here is what's the underlying doing? Underlying. And then checking out, their basket of funds, just kind of seeing what they're doing. And these ones pay out monthly. The other ones have been doing is weekly. These are monthly payers. So you're going to see they're going to be larger dividends than the others. And then my last one I kind of going to go into is going to be Curve. Curve is, I don't actually really hate a lot for what they're doing. Their precious metal ones, not too shabby, pretty consistent. Despite the beating that silver just got into, and I'll go into that one next. You can see that gold over here, it started at 25, it's at almost 35, and we've had pretty consistent dividends on this. Granted, very much in its infantile stage, and with only doing monthly distributions, we only get 1 data point per month, 12 data points per year to really kind of start capturing to see what's going on this. Silver had been doing really good. It did crater in February. It took a beating, and in doing so, we see a $5 decrease in the NAV. But from where it started at 25 to 42, it's still not too shabby. As well as we're seeing the dividends increase month over month. So like I said, I like Curve. It's not doing too bad. Then we start getting into their tech stack over here. So this is going to be off Triple Q, and we start at 27, we're at 25. There's some fluttering in there, but it's not too bad. Looks relatively consistent. And then you look at the dividends starting at 15, and as it's gotten more comfortable, they've actually increased it. And I think that's them just trying to be mindful of their particular strategy and not just issue out large dividends and crater the NAV. Going into their single stock investment strategy, this is also going to depend on the underlying. We started at 33 and we're going to end over here at 22. Not so much fun, but the dividends have been relatively consistent. Their Apple one starting at 24, we're over here at 23, and 25 cents pretty much is going to be its running average. Not too shabby. I love the name of this one, Goop. But starting off at 30, we're over here at 37. We actually have growth. Okay, great. And then we look at what's happening with the dividends. I think that's also them trying to be mindful of the strategy and making sure that they're being cognizant. So, the fact that they've been increasing it as well as with the NAV going up, this is good. MSFI, so this one is also 26, 18. Man, these dividends are all over the place. NFLP, this is their Netflix one. We're at 36, now it's at 23. And then look at the distributions on it. It has just going down. But it's going down as the NAV is going down. It's corresponding. And then TSLP, this is going to be off the Tesla one. We're at 20, started at, close to 30 over here. It's feeling it, and they're just kind of seeing what they're going to have to go do with it. It's been stabilized at 50, but whether or not they make that change down to maybe like 25 or 30 cents to help try and stabilize their NAV, we'll see. But ultimately, that's where we are with this episode of the Casino Update. You gotta do your own due diligence. Do the research before investing in. Don't get hung up on the high yields. We can see that, yes, it's lucrative. Then you're gonna have the tax drag on it if it's not in a qualified deferred accounts. Then the second part about it is what is going on with the underlying. You gotta like the stock and what you're doing. You gotta like the company that you're with and what their strategy is, because we can tell that, hey, high yield, high NAV loss, or maybe we go something a little bit more, conservative, doesn't have the weekly dopamine hit, but hopefully we're seeing some upside appreciation with the income, or ultimately everything you do is at risk. I would say stay away from margin as much as you can. I think if you can't manage it appropriately, you can over leverage yourself, and over leveraging yourself is a good way to get caught in a bind, especially if we go into a recession here and the overall market, the stuff tanks. That little maintenance requirement can change a lot differently overnight, and you can find yourself losing everything. So thank you for tuning in to this episode. I hope you found it informational. If you have any questions, feel free to reach out, leave a comment, hit that subscribe button, and thanks for tuning in.